Good afternoon. My name is Giedra Versetsky. I would like to represent today about financial reporting. International Accounting Standards Board conceptual framework. What it is? It's the principles that guide how financial statements are prepared under IFRS and issued by IASB to ensure global consistency, clarity, and transparency. What kind of benefits it giving? Ensures consistent application of IFRS across entitles, improve compatibility for investors and stakeholders, provide guidance when no specific IFRS standard applies, supports development of high-quality principle-based standards, and chase overall usefulness and reliability on financial information. Key concepts defines financial elements as assets, liabilities, equity, income and expenses, qualitative characteristics, relevance, faithful representation, comparability, verifiability, timeliness, and understandability. Provide rules on recognition and measurements. AIS 36 employment of assets. Purpose of it is ensure assets are not carried about their recoverable amount higher of fair values, less cost of the disposal and value in use. Explanation and example for it would be an impairment occurs when an asset's carrying amount is higher than the amount that can be recovered through using or selling the asset. When this happens, the asset must be written down to its recoverable amount, and the difference is recorded as an impairment loss in profit or loss. Example, carrying amount of machine is 500,000, recoverable amount is 380,000, impairment loss is 120,000. Recognition. So impairment loss recognized when carrying amount exceeds recoverable amount, applied to individual assets or cash generating units. Internal measurement. Assets are first measured according to the specific accounting standards that applies to them, such as IAS 16 for property, plant and equipment, IAS 38 for intangible assets, for IFRS 16 for leases. This means they are initially recorded using either the cost model or the relevant model, depending on the requirement of that standard. IAS 36 does not determine the initial value of an asset. It is used only when assessing whether asset is impaired after initial recognition. Subsequent measurement, impairment testing. At each reporting date, check for indicators of impairment, perform annual test for goodwill, indefine life intangibles, and assets not yet in use. If impaired, reduce assets carrying amount to recoverable amount and recognize loss in PL. The recognition or reversal, if recoverable amount increases in future, impairment may be reversed, except goodwill. Carrying amount cannot exceed the amount that would have been no impairment occurred. IFRS 5, non-current assets held for sale and discontinued operations. So explanation of the standard. IFRS 5 applies when a non-current asset or disposal group is exceeded to be sold rather than used. An asset is clarified as held for sale when it's available for immediate sale in its present condition and the sale is highly profitable within 12 months. For example, a company decides to sell a building. Management has committed to the sale plan. The building is actively marketed and buyers are accepted soon. It must be classified as held for sale. Initial measurement, when classified as held for a sale, The asset is measured as the lower of its carrying amount and fair value less cost to sell. Depreciation stops once the asset is classified as held for sale. Recognition, discontinued operation is a component of an inventory that has been disposed of or is classified as held for sale and represents a separate major line of business or geographical area. Results of this discontinued operations are reported separately in the statement of profit or loss. The recognition, when the asset is sold, it is removed from the statement of financial position, and any gain or loss on disposal is recognized in profit or loss. If the sale plan changed and the asset no longer meets the held for sale criteria, it must be reclassified back and measured at the amount that would have been recorded had it ever been classified as held for sale, including depreciation. Subsequent measurement. At each reporting date, remeasure at the asset at the lower of its updated carrying amount and fair value less cost to sell. Any loss from remeasurement is recorded in profit or loss, and gains can be recognized only up to the amount of previous losses. IAS 21, effect of changes in foreign exchange rates. So explanation of the standard would be provides guidance on how to account for transactions and balances that involve foreign currencies. The standard explains how to determine the functional currency of an entity and how to translate foreign currency transactions into that currency. For example, company whose functional currency is the a company whose functional currency is the pound sterling purchases inventory from a supplier in the United States, for example. The transaction is recorded in pounds by converting the dollar amount using the exchange rate on the transaction date. If the amount is unpaid and the year and the liability must be retranslated using the closing exchange rate, and any difference is recorded as an exchange gain loss. Recognition. Exchange gains and losses are recognized in profit or loss when they arise from monetary items. When consolidating foreign operations, exchange differences from translating the results and the assets into the presentation currency are recognized in other competitive income. Initial measurement, foreign currency transactions are recorded by converting the foreign currency amount into the functional currency using the exchange rate on the date the transaction occurs. This applies to purchase, sales, expenses, and any transaction denominated in the foreign currency. Declaration. When a foreign operation is disposed of, the cumulative or foreign exchange differences relating to the operation which were previously recognized in other competitive income are reclassified to profit or loss as part of gain or loss on disposal. At each reporting date, maternity items such as receivables and payables that are denominated in foreign currency are remeasured using the closing exchange rate. Exchange difference arising from settlement or remeasurement are recognized in profit or loss. Non-monetary items measured at historical cost remain at the exchange rate on the transaction date. Non-monetary items measured at fair value and translated using the rate when the fair value was determined. Revenue from contracts with customers. Initial measurement at the start of the contract, the entirety measures revenue based on the transaction price, which is the amount expected to be received from the customer. The entity identifies the performance obligations and allocates the transaction price to each obligation based on their relative stand-alone selling prices. Explanations of the standard. So provides a 5-stamp model for recognizing revenue from contracts with customers. The objective is to recognize revenue in a way that reflects the transfer of goods or services to the customer in exchange of the amount the entity expects to receive. Company sells, for example, a company sells a computer for £1,000 and provides a 1-year service plan. IFRS 15 requires the company to identify these as 2 separate performance obligations and allocate the transaction price between them. Revenue is recognized when each obligation is satisfied, meaning the sale of the computer is recognized immediately, while the service plan revenue is recognized over the year. Recognition. Revenue is recognized when the entity satisfies a performance obligation by transferring control of goods or services to the customer. Recognition may occur over time, such as with service contracts, or at a point in time, such as sales of goods. Contract assets and contract liabilities are recognized depending on whether the entity has performed before or after payment is received. Subsequent measurement. As the contract progresses, the entity progress towards satisfying performance obligations. Revenue is measured and recognized either at a point in time or over time, depending on when control of the goods or services transferred to the customer. Any changes in the transaction price are relocated to the performance obligations on the same basis used initially. The recognition. Revenue previously recognized may be reversed in the contract if the contract is cancelled or if collectability becomes uncertain. When a contract ends, related contract assets or liabilities are recognized and any remaining balances are recognized in profit or loss. Leases. So, leases explanation and the standard. Requires leases to record most leases on the balance sheet by recognizing a right of use asset and a lease liability, which reflects both resource controlled and the obligation owned. For example, when a company leases equipment for several years, it does not simply record the payments as rental expenses. Instead, it recognizes a right of use asset for the equipment and a lease liability for the future payments, and then accounts for depreciation and invest over the lease term. Initial measurement. At the start of the lease liability is measured at the present value of future lease payments using the appropriate discount rate. The right of use asset is initially measured at cost, which includes the lease liability amount along with any direct costs, prepayments, or adjustments for lease incentives. Recognition. A lease is recognized when the lease obtains the right to control the use of a specific asset through the lease period, which establish both the asset and liability at the commencement date. Recognition reflects the economic substance of leasing, which treats the arrangement similarity to financed use of an asset rather than a simple rental expense. After initial recognition, the lease liability is updated by increasing it for interest and reducing it when lease payments are made. The right of use asset is subsequently measured through depreciation over the lease term and adjusted for any impairment if signs of reduced recoverability appear. The recognition. The recognition occurs when the lease ends or the underlying asset is returned or disposed of, at which point the right of use asset is removed from the accounts. The lease liability is derecognized once all obligations under the lease have been settled, and any difference between the final amount paid and the carrying amount recognized in profit or loss. So this is the references. Thank you for your attention.